All right, guys, welcome to a random housing market update. It is Tuesday. We typically do our Wednesday night lives, which we still are going to do this week. Last week we did a Friday. Now we're coming at you on a Tuesday to talk about some of the economic data that came out today with regards to producer price index. So PPI, we're going to be talking about the month over month. We're going to be talking about the core, and we're going to be talking about how that might affect your decision to rate lock based on the information that's coming out tomorrow. So, Josh, I know we're just on here right now, you and I streaming. This is random. We may have no one show up, but let's start by talking about PPI.
It's much easier to talk through the computer than it is in face-to-face. So it is good times, Jeb. So the PPI, the big news today was it actually came out hot, and which would normally be bad for interest rates, especially in light of CPI, which is much more important than PPI coming out tomorrow. You get a hot PPI read the day before, markets might start going, whoa, who knows what happens tomorrow? I just want to get the heck out of the way. And we saw that for a minute. And then as we dive deeper into the data, massive revisions for last month. We've talked about this on the show. The early part of the year, January, February, March, we had really, really hot, much hotter than expected employment reports. But every month was a big revision for the month prior to that. The markets don't trade off revisions. The news doesn't pump headlines about the revisions, but the revisions here are really important because when you look, year over year, PPI has not moved despite this hot month because last month, which was a strong, higher than expected producer price inflation, was actually revised down to a negative. If we had a negative 0.1 last month, which is what it was revised down to, the market would have improved greatly. Instead, we had a fairly strong number, stronger than the market wanted, stronger than the market liked seeing, and the market sold off. So really interesting that we are losing faith in the data that is being released monthly. And for us, I look at the revisions and go, the revisions are telling a story that we think we're seeing more in terms of boots on the ground. But more importantly, what does that mean if you're in escrow, closing in the next 30 days and not currently locked?
Yeah, I mean, month over month, we saw a jump of 0.3. We saw the revision from last month go down by 0.3. So the year over year numbers actually look the same. And so the market's taken it in stride. The 10-year has improved today. With that, we're probably seeing a little bit of improvement in interest rates. Josh, you can speak to that here in just a moment. But for people listening at the moment, this is what's important. Tomorrow's CPI. CPI is the market mover. It's the one that has the potential to have the biggest impact, not only on the 10-year, but on mortgage rates and just the direction of where housing goes to some regard. If you see rates come down considerably, if you see CPI beat at all, chances are you're going to see an improvement in interest rates, which in turn is going to stimulate some buyer demand. Maybe not immediately, but it's going to happen. And that could change the potential outlook from the Fed if we start to see those numbers revised. So, Josh, what did we see today with PPI coming out with the 10-year now sitting at what, 4.43 or something along those lines? Or maybe it's a little bit higher than that.
444. Four is all the way across.
444. And if you were in a position today to lock a loan, would you lock it or would you risk taking it into the CPI data tomorrow?
So we got 4 new contracts in over the weekend. None of them are huge. None of them are small. They're all $300,000 to $400,000 loans. So pretty representative of what we see around the country. None of them are locked right now. My afternoon when we finish this is talking to those people and having this exact conversation. I think you could justify either decision right now. A lot of it comes down to your risk tolerance. If you can deal with lost opportunity more than actually lost dollars, then you go ahead and lock. If you're the type of person that, hey, if you lock today and we get a big revision on CPI from last month down, or the number is just weaker than what was expected and the market rallies big tomorrow, like, let me see if I can share this here, Jeb. I believe I can share the old screen.
While you're doing that, Josh, I'm gonna transition. Well, not transition. I'm gonna ask you a question in another way. If you didn't have a lock and you were closing in a week, would you risk the volatility with potential tomorrow to take it through tomorrow? Or If you're 30 days out, you got some time for things to make up in that time frame, if you will, volatility to subside a little bit. What are your thoughts on those two different variations of the question?
If it were me, 7 days or 30 days, I would float. But again, I follow this on a daily basis. So what I think is probably the right answer for most borrowers in that situation, about 65% of people should probably be locking. And I think the data here, Jeb, is really helpful in terms of when we look at this. Actually, I got to get back to that other one. Hey, what did I do, Jeb? Here we go. So we've been talking about this channel, and this is actually a weekly chart, but the up channel is intact, which tells us that interest rates are getting worse. But we've wanted an opportunity to break out of that channel. Tomorrow, my brain says it wants to break out the bottom of the channel. That can be optimism. I could be totally wrong because there's one of two things is likely to happen tomorrow. Either we get weaker than expected inflation numbers in terms of CPI, and it pushes us out the bottom of this range, or we get hotter than expected CPI figures, and we're going to run all the way back up towards that top red line, and it's going to get worse. So you just have to ask yourself, am I going to be more frustrated if I don't lock and tomorrow my rate is 1/8% worse? It's not going to shoot back up to the top of this channel. I mean, the difference between where we're at right now and the top of that channel is 0.5 to 0.75% interest rate. If that was what we were looking at, that, hey, in 10 minutes tomorrow morning before you can lock, you're losing 0.5%, then everyone should lock. But when we look at it, the reality is you're probably risking losing 1/8 on your interest rate. And if you've been floating over the last couple of weeks, you've probably got a quarter improvement. So, in terms of looking at that, I'm trying to get this thing improved here. This is on a daily basis.
Oh, I actually took you off. So if you want to go back, you gotta.
Yeah, just throw it back up, Jeb, just because what we're seeing there in terms of
wrong one, using all kinds of stuff here.
So this is the daily chart here, and this is the important part. Over to the right, you can see we're moving towards that lower bound of that red uptrend. But for a week here, because CPI was coming, the market didn't really want to take a position. They're like, hey, they kind of want to get a look at it. Traders kind of want to get a look at that data tomorrow. So we've just been trading sideways, some intraday volatility, but not a whole lot of movement. So if you put yourself under contract 2 weeks ago and you're already sitting on an 1/8 or a quarter of improvement, you can justify locking it. But what I will tell you, people do beat themselves up when they lock their rate and the rate then turns around and improves on them. But not nearly as much as the people that don't lock and then see it get bad on them real quick.
Well, what I've noticed, Josh, in doing this, for as long as we have, is if people miss out on rate locking, they wish they would have locked the rate. And if rates improve and they have locked, they wish they would have floated. So it's kind of a lose-lose situation in these, but it's only because of the emotion, the emotional part of it. And in all reality, they should be happy that they did what they did, just to not have to deal with the volatility piece of the puzzle. So for those of you just tuning in, Wednesday nights is our typical live. We've been exploring random days, random times, just popping on, no preview at all. Hey, Josh, do you have time to go live? Let's go answer some questions. Let's talk about the market. Today is really prepping you for what's to come tomorrow. Josh, CPI tomorrow is supposed to come in with a 0.4 handle. Is that right? 0.4? 0.4, which, depending on what you look at, so, and here's the thing is a 0.4 is dropping off. So if inflation comes in at 0.4, you're going to see the headline numbers stay the same. It's going to say basically inflation is going nowhere. That's what the headlines are going to read. Now, hypothetically speaking, it comes in at 0.5. Just a little bit higher. It doesn't even have to come in at 0.5. It can come in at 0.45 and it'll round up to 0.5, which in turn will take that number up to 0.5 because they round those numbers, and it will say inflation is still, heavy, no control. We can't control inflation. It's out of control, whatever. And it's likely to have an impact on mortgage rates. And the same is true for if we get a beat. It's going to say that inflation is continuing to go down. But Josh, something that is important to note is the next month, which would be June and July numbers for inflation, very, very low numbers coming off. And if we continue this trend at 0.4, which is what it's been for the past 2 months, so March 0.4, April 0.4, if May comes in at 0.4, then we essentially, what's that turn into annually, Josh? 4.8%
Yeah.
inflation. So higher, much higher than where we are now. But chances are you're going to see inflation go back up. Maybe not tomorrow, next month, the following month, before you really see inflation go back down. Any thoughts on that?
Jeb, we got a couple comments here, and let's throw them up because they're valid. Darit says, I think a bit hotter CPI, but the market would just shrug it off just like today. They didn't shrug it off today because they were like, oh, no big deal, it's hot. They shrugged it off because the components inside of there that trickle through to PCE were actually light, and it's telling us that PCE, the Fed's preferred measure, is probably trending in the right direction. And most importantly, those revisions last month. The market didn't just go, oh, hey, no big deal, that's a really hot number month over month. But I think there's some truth to what you say, because I look at that chart and I go, I'm expecting a breakout. Either we're going to break out to the bottom of the range, or we're going to make that run to the top of the range. If we get something right in line with expectations, even if it's a little hot, the market's going to go, oh, whatever. I guess we kind of stay in this trend and keep going sideways until we get next month's jobs report will be the big one. We get PCE, but the market hasn't been trading PCE. So that's it's a very valid thought that there is a chance that we get a slightly hot number tomorrow and the market just goes, whatever, we don't care. Chris G, another regular viewer, says, I still have clients ask me, will ever see a 3% mortgage rates ever again? I'm willing to bet not in the next 10 years. I think you're insane if you're willing to take that bet. You're probably right, but I certainly wouldn't wager nearly anything on it, because in 2013, 2014, we had the taper tantrum, and go back and pull up. There's 9,000 articles that you could cite that say, we're never going to see rates in the threes again. We didn't just get them in the threes. We got them all the way down in the twos. If you take away the pandemic, where we had kind of normalized to was low fours, high threes would have been normal. So now the question becomes, what's the new normal after all of the weird distortions and fluctuations? So personally, I believe that where we're at now is a little bit higher than normal, but is the new normal 6.5, 5.5, 4.5? You're probably right that 3% ain't coming anytime soon, but I've seen enough weird stuff happen, and we've seen the Fed now react twice, the federal government and the Federal Reserve react twice with monstrous stimulus that can move the market in ways that you can't understand or follow. So you're probably right, but I would not take that bet.
Real Estate Curious is, with the contract rules coming in effect in August, as a seller, what would you offer as a commission rate for a good agent? To each his own. I personally believe, and you may call me crazy, that the change isn't going to be nearly have nearly as big of an impact as many people think it will. I do believe that if sellers want to get top value for their home, they want a professional agent on their side, they're still going to be paying somewhere between 4 to 5% commission. But it's negotiable, right? So you could have some good agents that don't understand their value, they can't convey their value, and are willing to accept less. But I think when you have an agent that understands the market in that or the neighborhood in a certain market and can show you what other people are doing, how you can stand out, or how you need to compete by offering certain commission, and how it translates into a higher price, I think it's worth considering as a seller. But that's just me personally. If I'm a seller, I would offer almost a higher compensation to the buyer's agent than I would the listing agent. It sounds crazy, but the reality is the buyer's agent probably has access to more buyers. The listing agent is still going to do their thing. And there is a lot of work for a listing agent. I'm not downplaying it at all. I list more properties and I help buyers buy. But if I were a seller trying to stand out in the market, trying to get the most exposure, to create the most demand, to drive the price up, I'm going to do what I need to do to be able to get more buyers to look at that property. And that's not having them have to pay their own compensation to their agent. Just my thought. But we don't know, right? We're a couple months out from this. It's going to happen. I think it has to happen by August 17th. So it will be a conversation starting in the latter half of the year. We don't know the effects of it yet. And like anything, real estate being local, I think If you're in a super, super competitive market, inventory super, super tight, you probably are going to see more sellers not offering compensation to buyers versus a balanced market. Probably see a good amount of it. If it's a buyer's market, if you have a lot of inventory, guess what? In order to stand out, you're going to have to do something different, and compensation is one way you can do it. Just my thoughts. Josh, surprisingly, 66 people on here just showing up on a whim. So let's see. I'm just clicking on some stuff because it's hard to read it and actually decide whether to not to click on it. So we're just going to click on some stuff. Lendering offering $20,000 in incentives.
Would you rather?
Would you rather pay closing costs or buy down the rate? $1.2 million loan. Josh, what are your thoughts on that? For a while there, you were saying, hey, use it towards closing costs. You know, rates are probably going to go down. Is that still the belief presently?
Either choice here is valid, and you have to decide what you believe. Again, what would Josh do with 29 years of experience in this, and what do I expect happening to go forward, and what would you do? Often two different things, and both can be valid. So for me, I would absolutely use it to pay closing costs, have as little sunk costs into this transaction as possible, and position myself to refinance when rates drop. On a $1.2 million loan, 0.25% is worth doing. So a $1.2 million loan, that's less, $20,000 is less than 2 points. You're talking about less than 0.5% move in the market. I am very, very confident that in the next 5 years, we're going to have an opportunity to refinance to a rate lower than 0.5% below where it is today. So you'd have to see the numbers. If they're making you an offer you can't refuse, if it's just makes the payment more comfortable, having the permanent buy down, not a temporary buy down, but having that permanent buy down is insurance against Josh being wrong and rates never going lower, or your belief that rates are going lower. It's insurance that here is my worst case, for the next 360 months, I make this payment and I'm good. So you have to ask yourself, what's your comfort level with the payment as it sits? What is your belief that rates are going lower at some point in the next 2, 3, 5 years where you could realize that benefit without having to pay for it?
All right. And then we have a follow-up question asking, when they say incentives, what do they mean? A $20,000 discount? No, typically what they're saying, well, you can look at it as a discount depending on how you're framing it. But typically when they're saying incentives, they're offering you a $20,000 credit to use towards closing costs and or to buy down the rate. Now, here's what's funny to me, Josh. And this is, I'm not picking on anyone. I'm just posing the question because when I always say most people live in the payment, not the price, right? They say, no, Jeb, you're wrong. I would rather have a less expensive house with a higher rate than a higher price house at a lower rate. And I say, no, that's why people lease cars. They're always looking for the lower monthly payment. And then you pose a question like this that says, hey, if the seller's willing to give you $20,000 to lower your rate and or give you $20,000 off the asking price, which are you more likely to do? Most people are more likely to buy down the rate because it's the payment, not the price. They live in the payment. So just wanted to throw that out there because that's the mentality for most people. Even though they want to believe that they would like the lower priced home, they want the lower payment regardless of how that shakes out.
And Jeb, it's that way at all times. It's even more so right now.
Absolutely.
Episode of the podcast dropped today talking about affordability. How do we fix affordability? When affordability is strained, when debt to income ratios are at all-time highs, or at least near-term highs for the last 5, 10, 15 years, it's a reasonable thing that, hey, if I could buy my rate down and my debt to income drops 2, 3, 4%, that's breathing room in your monthly payment. So Jeb's right at all times, but it's especially right in the
You hear that?
market.
You hear that, wife? Josh said, I'm right at all times.
I have a feeling he's going to go and edit that out. And he's going to have a button on your little stream deck where you say, Jeb is right at all times.
You brought it up, so I will absolutely have that by tomorrow. I appreciate that.
We're going to have to hear that 7 times every episode.
That's fantastic. $1 billion idea says, what realtor do you like for a 2,600 square foot 4.3 in Laguna Niguel, estimated at 1.8 million? I like myself. I'm not sure what the question is exactly. But in fact, I have clients right now looking under $2 million in Laguna Niguel. So we're actually depending on what you have there, that could be a potential for them. But would love the opportunity to discuss it with you, but that's neither here nor there at the moment. So if it's a possibility, reach out to me and let me know. Josh, you mentioned the podcast a moment ago. The podcast dropped this morning on the Educated Home Buyer, the podcast and the YouTube channel. It's a conversation with Ed Pinto from the American Enterprise Institute, the housing center portion of that think tank. Really insightful conversation. I can say we've been doing the podcast for 2 years. I learned more in that hour with Ed than I have in altogether in any of the other podcasts that we've done, just because he took it back to a historical perspective, talks about why we're in the position that we're in now with housing supply, how it started, basically how to solve it. And it's just a good conversation from somebody that, is kind of neutral on, we don't talk about the direction of housing prices so much as we do, how do you fix the problem that's out there? So I would encourage you to listen to it, if nothing else more than to learn. It's just a good conversation. So
Jeff,
if you haven't done so, go check it out.
What a banana is. We didn't even know what a banana was before this conversation. So if you don't
build absolutely nothing anywhere
near
anything, never ever
near anywhere, anything, anytime.
Yeah,
but it's interesting. It's a very good one. And the funny thing is, you guys, people will often comment about titles, thumbnails, whining, complaining that it was misleading or wasn't. That one is a really hard one to title. It's a tough one to throw a thumbnail on. It's not performing as well as some of the crazy videos that go up, but probably the most valuable. So don't wait for the algorithm to pick the title or the thumbnail for you. That is a really, really good episode. It's one of the longer episodes, but a lot of excellent information that you won't hear anywhere else. And it's not from Jeb and I. Jeb and I talk a total of about 5 minutes. The rest of the hour is Ed.
There's no insight coming from Josh or I. It is all Ed, and it's good information. And I would encourage you, if you like stuff like that, to let us know, because we're always looking for really good guests. A lot of people don't know who Ed is. I mean, we've had Barry Habib on, we've had Lance Lambert, we've had Logan Matashami on, and these are people that, if you follow housing, you kind of know who these people are to some degree. I guarantee you 99% of our audience has no idea who Ed is, unless you just happen to get his newsletter and read it. But it's a good conversation, probably, in my opinion, better so than the other 3 guests that I just mentioned, just because it's different. It's entirely different than what we're used to talking about. All right, Josh, we got a lot of regulars on here. Do you guys not work? I mean, what time is it? It's 2 o'clock here.
The YouTube
5 o'clock on the East Coast. See how quickly I did that math, Josh? It's just, almost had a math degree, guys.
The Kinston came out of you. Your brain flashed
add 3 to any number or subtract it really quickly. Let's see, Josh. Any last let's see here, comments? I mean, we said we were going to do about an hour. This was from ZL. Says, I don't see any urgency by state or federal government on real solutions to improve affordable housing. Is there any reason for government to care aside from votes, Josh?
We talk about it in the episode, so I'm not going to tell you go back and listen to things, but one of the things that we talked about is how the government solution is pushing people towards renting. So we talk about in the episode, Beverly Hills, hey, you're not building enough affordable housing. Well, they're not talking about build nice affordable condos. They're saying throw up some high-rise apartments where people can rent. And Ed kind of talks about how that is some of the highest cost construction that you can make. So you're building expensive units. Builders want to go towards high-end Class A stuff where they can get as much rent as possible. The government says, no, you got to make it as low end as possible. But the solutions the government keeps coming up with, and again, we go through this in the episode, is increasing demand. So like we saw during the pandemic, cutting interest rates by buying treasuries and mortgage-backed securities. And it worked really well, pushed asset prices through the roof. And then also saying you have to build this stuff, but hey, we don't have very much land in Southern California. So take that plot of land that could be 12 nice big houses or put 112 affordable units on it that no one wants. So again, at risk of saying just listen to the episode, Ed really goes back and some good solutions and gives some context to how different communities, Philadelphia, Houston, Seattle, have sort of battled this and pushed for light density, but more dense than single family, giving people affordable housing. And you may be saddened to find when he's talking about affordable housing, some of these areas like Seattle, he's saying they were able to build $700,000 units. Well, when the median price is 1.1, 700 qualifies as affordable, while to many people that will never be affordable.
No, good stuff. And I mentioned the question a moment ago, don't you people work? And everybody's like, hey, I'm at home. Like I work from home now. I forgot with the whole work from home, you can actually multitask. You can just put this thing on the background, do your thing and keep going. So thank God for work from home and us being on YouTube, Josh. It just kind of goes hand in hand. It works out. People can get education and still do their job. And it's a win-win. But there's a good question here, Josh. One that I don't know that we've ever gotten, if I'm being completely honest, says, where can I find out if I paid to buy down my rate? Is it on the closing statement? So Josh, does that show up in box A? And how could you ever close on a loan without knowing that you bought on it or paid it down?
You should have known. Someone should have walked through. So from the lender, you're going to get a closing disclosure. From the settlement agent, whether it's escrow, title, depending on what part of the country you're in, they're going to give you a settlement statement. The settlement statement is nice and simple, dual entry bookkeeping, debits and credits of everything there. And there would be a debit to you for having paid points for that interest rate to buy it down either temporarily or permanently. If we're looking at the closing disclosure, box A will show all of the fees paid to the lender and or the broker, including discount points to buy down that interest rate. So either one of those would give you the information that you're looking for.
All right. Good stuff, Josh. Let's see what we got here. What do you think is going on with property insurance? We've talked about this a little bit.
We did an
property
entire
insurance
episode on it.
We did. It's gone up considerably. But I guess let me ask this question. Let me phrase it a different way. Is the cost going to continue to rise, or is there potential relief in sight, some sideways movement with regards to insurance and not this huge increase that we've seen recently?
You'd have to ask someone deeper into insurance than us, but when you look at it, you would think that the increased cost of materials and construction has been accounted for at some point. So there's multiple pieces. Again, the short version is loss frequency and loss severity. So the loss severity means increased cost of labor and materials. The loss frequency, they're pointing out that we're having more natural disasters than we've had at any point. So loss frequency is unlikely to go back to where it was. So when you're trying to insure for risk going forward, it's a difficult one. It will be interesting to see where it goes. You'd absolutely like to see it level off. I don't know about going back down.
Yeah, I mean, again, like you said, not enough information to really talk about it in any detail. So I just think, if you're in one of these states that has higher risk to natural disasters, Florida, Gulf Coast of Louisiana, parts of Texas, I mean, you're going to see probably rising insurance costs. The cost to rebuild a lot of these things it's all of those things added on to one another, and there's probably no relief in the short term. But it's hard to say. So if you're actually out there buying a home, insurance is one of those things I would get quoted early in the transaction. Don't do it at closing. Get it early in there so you know what you're going to be paying. You can do it as early as getting pre-approved for a loan. Find out what your, potential cost is going to be and factor it into your budget to make sure you can still purchase at that price. On a separate thing, Josh, we got a question last week. I don't remember if it was on the Friday one we did or the Wednesday, and they were asking why the cost of, or why there were so many condos sitting on the market in Florida, even on the rental side. And I happened to read a good article last night in the Wall Street Journal. You've probably seen it, about all of these condominium complexes in Florida with, the cost to procure, if you will. So basically Florida passed some sort of law that required these homeowners associations to now have up to, I think, like 40% of their, in reserves in order to be able to maintain and bring these buildings to code. Anything that's more than 30 years old falls into this category. And, there's people out there that bought for a couple $100,000, like $300,000, are now selling these things for $100,000 and just letting them go because the association are passing assessments that are $150,000, $200,000 to get each unit, or not each unit, to get the building. And they basically broke it down by unit. And in order to to fix the quote unquote problem, and these people can't pay it. And therefore, you've got a lot of condos sitting on the market. There's one building that they mentioned. I can't think of the name of it specifically, but like 2/3 of the building, or 1/3 of the building was actually on the market for sale just because of those issues. And one thing that they're scared
Which
of
then
is
presents more issues in terms
absolutely.
of getting financing for it.
Well, that's the thing, is lenders don't want to lend on it when they have this. So a lot of it has to be cash transactions. And the other thing they're scared about is investors coming up and buying so much of the building and then holding majority ownership and then voting to tear down the building and rebuild something more of a class A type building that you're talking about. And they're trying to prevent that from happening. It's a nightmare. So you're probably going to see more regulation. I would at some point, right? We don't like government intervention. As we've mentioned multiple times, it typically swings too far in one direction or the other. And this is kind of one of those things that swung a little bit far in one direction, but you're likely to see something intervene at some point, I would think.
It'll be interesting. Florida in general is really interesting. We've talked on the show here before about Bruce Norris, an investor, an educator of investors here in Riverside. He's selling almost all of his properties in Riverside County and buying new construction in Florida. But again, that new construction, they can build these things to hurricane standards that, I mean, we'll find out the next time you get a gnarly Category 5 coming through. But their expectation is current modern building standards can make them not hurricane proof, but heavily hurricane resistant. So now let's flash back and say that's a little single family house that's relatively cheap and affordable to rebuild compared to a 50, 100 unit high rise, mid rise condo building, which is what a lot of these are. And they were built to codes that just, you can look at it and go, if there's a hurricane, that thing is going to have a problem, much less the implosion like you had of the one that fell down a few years ago and killed all those people.
No, exactly. Don't Sell says, what's up, guys? I just increased all of my deductibles on my properties and it does help. So that's one way to, I wouldn't say combat the higher costs, but it can help you out. And then you have, I mean, if something does happen, that kind of puts you in a bad position. But insurance is one of those things that we all hate until we actually have to use it, in which case we all love it at that point.
Well, Jeb, to a degree, those high deductibles are a form of hybrid insurance. When I say hybrid, you're getting insurance, but you're also self-insuring. So when it comes to anything, I had a client here from the show that we just closed a purchase on last Friday, and he was asking me, seller didn't agree to pay the home warranty. And he said, hey, would you pay for a home warranty? They want $700 for this property. And I said, in your situation, I wouldn't feel the need to, because he's very well qualified, good reserves. Nothing was going to come up with that property that he wasn't going to know about it. Because that's what a home warranty is. It's insurance against something breaking in the first 12 months on that home. And it also generally a fairly high deductible. So then he was also asking about my homeowner's insurance. Where would you set the deductible? I said, let's go back to the same discussion. You make good money, low debt to income ratio, plenty of money in reserves. I would set that deductible as high as possible. Save the money, the known money. And I would say this is now, we bought our home in 23. So 21 years in our home. I've never had a claim. Doesn't mean that we won't. It doesn't mean that no one in my neighborhood did. We had a claim on that house that I bought out in Orange, like immediately when we bought it, Jeb, and that was a $48,000 claim. So it's not to say that it doesn't happen, but that high deductible is something of a hybrid where you're saying, I can set aside $10,000 or $15,000, and then it's the backstop that keeps me from having a catastrophic $40,000, $50,000, $80,000 repair if something goes really wrong.
All right, good stuff. Yeah, I mean, the last thing I'll say about that is I have a buddy that lives in Florida. He's fortunate enough to have done well in his life and owns his property outright. He told me the other day, I don't have insurance at all. I'm not paying for insurance. If something happens, I'll pay cash. Like, short of that house getting completely destroyed, he'll be okay, because I mean, there's nothing there that would be a big enough issue that he couldn't pay for it out of pocket. And so that's how he looks at it. Not to say that most people aren't able to do that, but there are people that are looking at it like that just because, of where the cost is headed.
I read a story, Jeb, of someone in Florida that their premium went up to $20,000 a year. Their property was worth $200,000. They said, well, in 10 years, I'd pay for the damn property. I'll take my chances that it's not going to blow up on me in the first 10 years, and did the exact same thing. They owed like $15,000 on the property. They go, I'll take this year's $20,000 premium, pay the property off. Now I don't have to have insurance.
There you go. But if you do have a loan, you have to have insurance. Just FYI, guys. My wife just called me a moment ago. Said, Jeb, can you pick up our youngest? I'm running behind, so we're gonna have to bail here in about 5 minutes, and I'm gonna have to do that. But until that happens, let's answer a couple more questions here. Jay says, is it normal for a loan processing officer to request? What just happened?
I'm just looking at the question. That's a wild one.
To request bank account login information so they can monitor. Oh, I didn't read it. To monitor bank account activity until closing. No, that is not normal. No.
I want to make sure that you're not misunderstanding. Many of the loan origination point of sale systems, you can use Plaid that will you can tie Mint and Quicken into your accounts, and it will authorize them to see that information, but they don't have a login to your account. Anyone asking for your username and password at any time and place, you tell them no. If you go on and can authorize it to look at it and keep an updated verification of assets in there for you throughout the process, that's not uncommon. Most people still don't use it, just because a lot of people aren't comfortable with it. I'm comfortable with it, just like I am when I go to use, Quicken or any of that stuff. But it's a comfort level that you have to have.
Chris, I believe, asked this last time. It always comments on the beard. It says, will you make a video about it where you shave it into a goatee, handlebar mustache, and then clean shave? No, I won't do. I will never do a goatee. That's just, I don't know. I'm not going to comment. It's not Jeb. How's that? Handlebar mustache, I might be able to pull that one off. And clean shaven, my wife hates that. So kind of, you either get this or some hybrid in between.
Your face.
The other day, I keep going back between just let it go and I can't let it go. So I don't know what's coming, guys. It's a surprise. It's as surprised as you'll be when you see it on. I'm the same. Every day I wake up, I'm like, is today the day? No, not today. So anyway, we'll keep going here.
I want to make a comment on this, then I want you to answer this. James Welsh, buyer's remorse, just paid $715 for a $650,000 listing that had 8 offers. Forever home, nice suburban market. If you were a betting man, would you say that the value will be more than $715 in 10 years? The value today is $715. What the sign goes in the yard for, what the price goes in the MLS has nothing to do with the value of the home. 8 people lining up told you the market value of the home. It's worth $715 today. Jeb just recorded a video, the whole rent versus own debate that people are having right now because of the disparity in monthly prices. Yes, that home is going to be more expensive 10 years from now. Your thoughts, Mr. Jeb?
No, I agree with everything you just said. The reality is, people have buyer's remorse anytime they purchase anything that has any substantial value. If you would have bought it for $650, I bet you would have got buyer's remorse. That's just the reality.
I have buyers. Why did no one else want this house? How did I get it for $650?
Listen, I tell people all the time that if you make an offer on a property, that if your offer gets accepted, you're completely happy that you got the offer accepted. But if it doesn't get accepted, you have no regrets every time. And I tell people, hey, listen, if you put in an offer, for example, at $715 and it gets accepted, you're going to have regrets later on. Well, why did nobody else pay $715? Why did my offer get accepted? Why? And if you would have offered $714 and it closed and you didn't get it. And we said, hey, what did it close for? And they said $715. You would have said, I would have paid $715. Like without hesitating, right? Just because somebody else wanted it. So it's completely normal to have some sort of buyer's remorse, especially when you're spending that kind of money. But there's 2 things you said there. Forever home. Forever. Who cares? Who cares the price? Who cares about anything else? Make your payment, be comfortable with the payment. You have the longer term time horizon. It doesn't matter. Nobody's going to come take your home tomorrow if the value drops to 700. And if it goes up to 800, fantastic. And the reality is it's probably going to the longer you hold on to that home. So you're in a good spot. Don't beat yourself up. You did what you thought was right at the time. And I think that's all we can do as potential buyers out there in the market. You can't have hindsight and go back and wonder what if. You'll beat yourself up every time. I buy something for $200 sometimes and I have buyer's remorse. I'm like, did I really need that? Did I need that? And then time goes by, you're like, whatever, one of those things. So it's like you can have buyer's remorse on anything, but when you start spending hundreds of thousands of dollars, buyer's remorse is normal. Josh, it is 7. It is not 7. It is not 7:15.
Not
It
anywhere.
is
Not on
2.
the East Coast.
It might be in like the middle of the Atlantic somewhere.
Right.
It's 2:13 here on the West Coast, 5:13 on the East Coast. See how quickly I did that again? That we more or less have to go off here, but we're back tomorrow night, 5 p.m. Pacific Standard Time, 8 p.m. Eastern Standard Time with our normal hour show. Hopefully you guys tune in. We're going to have CPI. We're going to be able to talk you through that. And then we might pop on randomly Thursday or Friday. We'll see what happens. Josh, any final words?
No, but we did have one last critical question that we have to get to. VIP listener Wesley says, you ever get the pepper relish from Jersey Mike's? I just bought a whole jar of the stuff because they sell it now. So Wesley,
Never had it.
It's a little known fact that the greatest thing about Jersey Mike's is the pepper relish, and it should go on every sandwich they make. I just had it put on my tuna salad because it's also delicious on that. And I also, while I was there, looked over and saw a little display of the jars, and I said, that's awesome. But I had already checked out and whatnot. So next time I will be buying a jar to take home as well.
There you go. I've had Jersey Mike's no less than 100 times. Never knew anything about pepper relish.
Absolute best thing they have on the menu.
We'll try it. All right, guys, we will see you tomorrow night. Until then, buy right, borrow smart, build wealth. Adios.
Amigos.